So this is a summary of the key takeaways from Module 1, which covered the introduction to financial accounting and financial statements. Module 1 covered from the Coursera content 3 different topics: week 1, 2, and 3. Intro to financial accounting, recording of transactions and financial statement presentation, and fundamental accounting concepts. There is a much more detailed summary of the contents of Module 1 inside my courses in a Word document. What we're doing here is just a summary of the summary. So please watch this video just as a refresher of the major items of this particular module, but do read the Word summary, which has much more detail. The topic 1 was Intro to Financial Accounting. Here we looked at the importance of the information contained in financial statements, and then how it relates to different users, and also look at the specifics of which statements comprise the standard set of financial accounting statements. And thankfully, that number is 4 or 5, depending how you count, but a very limited number of statements, which are in every single audited set of financial statements. So thank God there aren't changing rules for different companies. The key takeaways as far as the terminology and concepts are concerned are accounting, shareholders, creditors, annual report, financial statement, balance sheet, income statement, statement of cash flow, and statement of cash flow. Now, all of these should sound familiar to you. I read them fairly quickly, but you can see them on the screen. If they're not, make a note of it and go back and review it. Same thing on the other side, on the knowledge and skills. Can you answer these questions? What is accounting? Or how do users utilize the information for different insights? Or what are the main financial statements? What type of information would you find in a balance sheet, or in the income statement, or in the cash flow statement? And how are they related? They're connected, but do you know how? So you should know the answers to those questions before you move out of Module 1, because they're all in there. So let's look at the statements a little bit more detailed and start with the balance sheet. It is the accounting equation of assets equals liabilities and equity. And stated as an English sentence, assets were acquired using borrowing or shareholders' equity. Oh, that makes sense. If you buy things, where did it come from? You borrowed it so that you could buy it, like a car or a house, or you use your own savings, your own equity, if you will, to buy whatever you wanted to buy. So that's what the balance sheet is. It's a point in time. It's always as of a certain date. And it's as of, say, December 31st, year 1. These are the assets we have. It was paid for by this combination of borrowing and our owner's equity. On the left side, you'll see that the assets are broken down into 2 blocks. This reflects what we call the classified balance sheet, which is current is separated from non-current. The definition of current are assets that are already cash or will be used up or become cash within 1 year. The key part of that sentence is 1 year. So if it's short term, 1 year or less, then it's current. If it's longer term, then it's non-current. Sometimes it's called non-current, sometimes it's called long-term, but essentially that's the same meaning. Notice a couple of the accounts that you probably would know, even if you knew no accounting. You know what cash is. So cash is cash. The other that you know companies have are property, plant, and equipment. The buildings, the trucks, the equipment they have, those are inside long-term because they last more than 1 year. That's the general idea of what's on the asset side of the balance sheet. Now on the right side of the balance sheet, we see the liabilities and equity because again, assets equal liability and equity. And we see that pretty vividly here, that we have $370 of assets and the liabilities were $233 and the equity is $137, totaling the same $370. Inside the liabilities, guess what? They're classified. You have current and non-current. Same definition, 1 year, but instead of assets that become cash, these are liabilities that you pay within 1 year. Same thing with long-term. Obligations you pay beyond 1 year. In the equity section, every company must have at least one class of stock called common. It may have others, but all have common. And then we have additional paid-in capital. We'll learn that a little later. And retained earnings, which is the accumulated profit that the company has made minus the dividends they paid out to their owners. So this is the amount of money we kept inside the company to grow the company in the future. The next statement is the income statement. This is an easy one to understand. It's profit equals revenues minus expense. And that's really all the income statement is. Well, more detail. This is a pretty typical income statement. It starts at the top with revenue. You'll find that in every single income statement. It ends on the bottom at net income. You'll find that on every income statement. What's in between are the details of what are the expenses, costs, and profits other than just revenue that may have arisen during the year. It's also in a very specific format. It starts with a high level revenues minus cost of goods sold equals gross profit. So that's how much you made from, let's say, selling a cup to your customers. What did you sell the cup for, and what was your cost of getting that cup? So that's how high level it is just the item you sold minus the cost of goods sold. And that's gross profit. Now, after that, we have operating expenses. We have salaries, we have rent, we have insurance. These are items that we would normally find in a company. So those are called operating expenses. The subtotal after that is operating income. So after you have gross profit minus operating expenses, you have operating income. After that are non-operating items. Examples being interest, gains and losses on sales. Those are other income. They're relevant, right? They have something to do with your profit, but it's not rising to an operating expense or a cost of goods sold. Then we have income before taxes. Often we just call this pre-tax, and that is the basis on which we determine the income taxes. After income taxes, we have net income. So I think this makes sense intuitively to normal people. It's just that we're now needing more precision when we look at financial statements analyzing an entire company. The third statement we'll look at now is the statement of cash flow. And this is looking at things from a different vantage point. The balance sheet and income statement, which we just saw, operate under the accrual basis. But we also want to look at how's the cash going. So this statement is devoted to looking at the cash generated or used from the business. Furthermore, it breaks it into three general activities. First being operating, then investing, then financing. Operating means how much did you get in cash or use in cash for running the business. So it starts with net income and then adjusts for any other cash ins and outs that were not reflected in the accrual basis income statement. An example, easy one, is if you sell something to a major company, but they haven't paid you yet, you will count it as revenue because that's what accrual means. You get to count the revenue, but you didn't get the cash. So in the statement of cash flow, we'll make the adjustment that although you counted the revenue and income, you didn't get in cash. So you did not get that benefit, and therefore it's an adjustment. The second section is on investing. It is what it sounds like. It's investing. It could be investing in securities, or it could be investing in buying additional buildings or equipment, or it could be buying another company. So these are examples of what you would do when you're investing inside of a company. The third group is financing, and this means financing from the standpoint of not just equity, but also debt. So these reflect the capital you got or the cash you got from borrowing or from selling more stock, or reductions in cash from paying back your debt or paying out dividends. So those are examples of what you find in financing. So those are the three activities, as they're called, in the statement of cash flows: operating, investing, and financing. Now notice that I didn't really fixate at all on the ending cash balance or net change in cash. That's interesting information, but the statement's purpose is look at the details of how you got there, not the end result. This is just an intro to financial accounting. If you looked at a 10K, this is a face sheet for Intel's 10K, you'll find that there are these three statements, but also a statement of shareholders' equity. This document is 300 pages, and it could be boring. Very few pictures, if any, very few graphs, if any. So it's mostly accounting and legal talk, right? So this is something we'll be looking at further, and it's an essential piece of your knowledge is how do you pick up a 10K and be able to read it and make some sense of it. You're going to make a big headway into that objective by the end of this course. So more on financial statements that are coming up in later modules. We just saw the three statements of balance sheet, income statement, and statement of cash flow. Later, we're going to see the statement of comprehensive income, which I view as an extension of the income statement, and then also the statement of shareholders' equity. Topic 2 was recording transactions and financial presentation. This is where it gets tricky. I've been teaching this for 20 plus years now, and this tricks students. Now, in the old days, we used to teach accounting using debits and credits. Some of you may have learned debits, credits, T accounts, and journal entries, but we use a different method for this course. It's called the template method, and it's far more intuitive and far easier to learn and operate. And it shows the big picture. So that's what we're going to use in this course. So if you've learned debits and credits, that's fine. All that knowledge and thinking through what happens in a transaction is still useful, but you're using a template as the means of recording the transactions. The learning objectives are to look at the process of accounting and the recording, then actually do the recording, and then summarize them so you can generate statements, and finally differentiating between accrual and cash basis. Content we already saw, the typical things we see in Coursera. All right, let's look at key takeaways. On the left side, terminology and concepts. So as I read these should all tick off in your brain. Got it, got it, got it. If not, highlight it and go back before you move on. The fundamental accounting equation, assets equals liabilities plus equity. The financial transaction, entries to record transactions, creating a financial statement from that summary, accrual accounting, cash accounting, balance sheet, and income statement. Now, in the knowledge and skills, you should be able to answer these questions. What information is considered a financial transaction? Or how do you record and organize financial information? Or can you build a balance sheet and income statement from those summarized transactions? And lastly, do you understand the concept and application of accrual basis accounting as contrasted with cash basis? The graphic here shows kind of this process of accounting where we start with source documents. We look at those that need recording and then we add them into the journal. And here the journal is again represented in the template. Then we post the entries to the template. We prepare the trial balance, which is a subtotal in the Excel spreadsheet. And then we present and formulate financial statements. So this is the entire process that happens every month. And you may have heard of the term closing the books. So we do this once a month so we can close the books of the transactions for the month and then generate statements that show what happened during that particular month. And we wrap up for a quarter, same thing. We summarize for a quarter, and then, of course, we summarize annually for our annual financial statements. If we use the accounting template, here's just a shortcut view of it. The top shows the template itself for transactions. The bottom shows the resultant financial statements of the balance sheet and income statement. And they're color-coded. So the blue section on the left side are for the balance sheet. The income statement on the right side is in green. First thing we do in terms of steps, we get the template, but then we post transactions row by row inside the template. Make sure that each row balances. In other words, that the assets equals liabilities for each of those rows. Now you might say, well, what about income statement? Well, what happens is the income statement is connected to the balance sheet by way of retained earnings. So we call this the articulation of the statements. And you could think of the income statement as exploding out the details of what happened during the year inside retained earnings. So that means it still has to balance. So if you had something affect a balance sheet item and an income statement items effect will end up in retained earnings in the balance sheet. So therefore, the balance sheet will balance. So that's a little bit of a two-step dance we do there, but it does work. Then we sum all these rows to get to a trial balance, and that is a summary of all transactions, including the beginning balance, so that now we have a running total of what happened in the period that we just accounted for. Third step is generate the income statement. We typically do income statement first because we use the income in the income statement as one of the items that updates the balance sheet. And that's the steps. Sounds easy, right? But this is the accounting process summarized in one slide and one template. It's far more detailed in a real database with millions of transactions a month, but that's just doing a million transactions a month. It's doing exactly this process. Now, a couple of general tips on how do you write the entries. I find this to be confusing for students, but if you stay nice and calm, it won't be bad. Again, starting on the blue, the balance sheet side, think of it as up and down. If cash goes up, it's a plus. If cash goes down, it's a minus. If your property, plant, and equipment goes up when you buy something, it's a plus. If you sold some equipment to somebody else, it's a minus. If you have inventory, you bought inventory, it's a plus. If you sell inventory to a customer, it's a minus. That seems too easy, so I should stop, right? But that literally is it, how we would increase for an asset going up, decrease for an asset going down. Now, the same holds for the liability and equity side. When we increase what we owe to somebody, it is an increase in liability and a plus. If we pay off what we owe to somebody, it's a reduction in the debt indebtedness, so it's a minus. On the equity side, if we sell stock to some new shareholders, it's a plus. If we buy back stocks from some shareholders, it's a minus. And finally, retain earnings. If we've added to profit, it's a plus. If we lost money, it's a minus. So that's it for the balance sheet, the blue section. You see this red asterisk? It means that it's not quite that way for every single thing. Most things it is, but the exceptions are what we call contra accounts, where we do an offset of a particular major account. And those accounts could be accounts receivable, which are offsets with allowances, or property, plant, and equipment, which is offset by its depreciation. All right. Now, moving to the right side, the green side, that's the income statement. If profits go up as a result of the transaction, it's a plus. If profits go down as a result of the transaction, it's a minus. Now, the reason I kept going up and down is that when revenue goes up, then profit goes up, right? You made more revenue, we're going to have more retained earnings. However, if expenses goes up, what happens to profit? Oh, it goes down. So when we record an expense, like we paid salary, it's not recorded in the green part of the template as a plus. We say, did it increase or decrease profit? Oh, answer, it reduces profit, therefore it's a minus. So I think that's the one item that may be a little bit confusing, but if you just remember, does profit go up or down, then you're in good shape. All right, now to accrual basis, which is GAAP and IFRS. So this is how all corporations record their transactions. It's on the accrual basis, which means, in very short form, that we recognize revenue when we earn it, and we recognize expenses when we incur it. Now, what are these words like incur and earned? When you earn revenue, you count it in your income statement whether or not the cash was paid. And then when you have an obligation, you owe money to somebody, you record it as an expense, if it's, say, salary expense, whether or not you paid it in cash. So accrual basis is more on the economic substance of what happened. So let's do an example to show how this works. One is a service completed and it's worth $5,000. And the second is that you had something done for your company and the cost was $300. On a cash basis, you don't count revenue until the customer pays you, and that triggers the entry. Also, you don't count the repair as an expense until you pay for the repair, and that's what cash basis means. On an accrual basis, the mere completion of the contract for the client means you've earned the $5,000, and you get to count the revenue when the service is completed and has no bearing on the cash received. Same thing, once the repair is done and done properly, you owe the money, and that's when you record the expense as a repair. So you can see that cash basis and accrual basis are very, very different. The third topic was on GAAP, Generally Accepted Accounting Principles, and these are the principles that underlie all of accounting. Sometimes these may seem to conflict with each other in a specific transaction, but there are certain GAAP principles that you will look at and they will be applied into how transactions are recorded. Our learning objectives were to identify those concepts, differentiate between accruals and deferrals, appreciate the importance of the conservatism principle, and also apply revenue recognition on different financial transactions. On the left side of terminology and concepts, we have the fundamental accounting concepts of going concern, conservatism, matching, consistency, accruals, deferrals, prepaid expenses, unearned revenue, contingent liability, revenue recognition, and accounting fraud. As far as knowledge and skills, you should be able to answer these questions. What are the fundamental accounting concepts and their impact on financial statements? What is the difference between accruals and deferrals? How does the conservatism principle impact financial reports? When can firms recognize revenue in financial statements? And how do firms circumvent accounting principles to commit accounting fraud? Not that we're teaching you how to commit fraud. Hopefully we're teaching you how to watch out for accounting fraud. This is a summary of the GAAP principles, generally accepted accounting principles. And they're very similar in practical terms to IFRS. So if you're in a country that uses IFRS, these are very, very similar in concept. The first is going concern, and this is where the firm will continue to stay in business for the foreseeable future. The second is conservatism, where there's a bias in accounting to not overstate profit or assets. One thing we were taught in auditing was never overstate an asset or understate a liability, because both of those would lead to problems where you're essentially misleading the user of the financial statements. Third is matching. This is when you sell a product or service, make sure that you record the revenue and all the associated or matching expenses. Consistency requires that a company's financial statement follow the same accounting principles, methods, practices, and procedures from one accounting period to the other. Accruals is where we recognize revenues when earned and expenses as incurred. We saw that earlier. And recognize revenue when the performance obligation has been met and as measured by the consideration related to those products and services delivered. This is a more technical definition of the more simple phrase of recognize revenue when earned. But this is the current and most precise definition of when to count revenue as earned. This is a summary of accounting terminology that we've seen in these modules. First is deferrals. This is the amount that was paid or received, but the amount cannot be reported yet in the current income statement since it's not an expense or revenue now, but it will be in a future period. Think of it as a holding bin until such time as it's recognized as revenue or expense on the income statement. An example is you paid prepaid insurance in a lump sum at the beginning of the year, but the expenses need to be recorded over the period in which the insurance policy covers. If we pay $12,000 on January 1st, that would be treated as a prepaid expense in the asset section. And then each month we'll use 1/12 or $1,000 to go out of the prepaid expense account and into the insurance expense in the income statement. So that's an example of we park it in the asset called prepaid expenses, and then once a month we take it out of the parking lot and we charge it to the income statement until the year ends, in which case we have zero left over in the prepaid expense account, and all of it, or $12,000, would have been charged to insurance expense, as it should be. The second example is the other side, where you get money in advance of you earning it. In this example, we receive subscription fees paid in advance, but the revenue is recognized over the term of the subscription. So let's say it's a subscription to a magazine for $60. So we got $60 up front, but we haven't given them the magazine yet. Each month, we'll give them a magazine and we'll count 1/12, or in this case, 60 divided by 12, or $5 in as revenues. So that's an example of both sides of a deferral, where we're deferring an expense over time or where we're deferring revenue over time. The second example is prepaid expense. That's the flip side of the deferral. When you have a deferral, it could be a prepaid expense like the insurance example. Unearned revenue is the example of the subscription. The next topic is contingent liability. Contingent liability means it's not certain yet. It's really dependent upon something in the future, hence the word contingency, right? Contingent upon a future event. Now here, the accounting rule is we have to assess the probability of a loss and that we can estimate the loss. And if those two conditions are existing, then we will record it on the income statement and balance sheet. If there is one of the conditions, for example, if it's not probable, then we don't record it at all. Or if it's probable but cannot be estimated, then we will disclose it in the notes to the financial statement, but not as an entry yet in the financial statements themselves, right? Those are contingent liabilities. Feels like alphabet soup when we look at regulators and oversight. We have SEC, FASB, GAAP, IASB, IFRS. Like, what are all these? Well, the SEC is the Securities and Exchange Commission. It's an agency of the U.S. government, and they oversee the public markets, the capital markets for stocks and bonds, and any security. FASB stands for Financial Accounting Standards Board. They set the rules for accounting in the United States, and it's a group of professional CPAs. It's not governmental, and they are essentially self-regulating. And they set GAAP, and they work closely with the SEC so that they normally cooperate and they adopt the same rules. Otherwise, it would get quite confusing if you were a publicly traded company in the United States. The IASB is the equivalent for international standards of the FASB. So it's the International Accounting Standards Board. They set the rules for what we call IFRS, International Financial Reporting Standards. So you can see them as parallel: FASB and GAAP, IASB and IFRS. All right. So with that, we cover most of the major companies in the world between FASB and IFRS. Congrats, you've completed Module 1. So look over these topics for 1, 2, and 3. They should all be clear based on your work, this video, and glancing at the Word document that is the summary. What we'll do next, after you're satisfied with your learning from Mod 1, is move to Mod 2, where the topics will be short-term assets, long-term assets, and liabilities. All right? See you on the next round. Bye-bye.